What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be taking a look at Chargepoint stock because we got a request to do an analysis for this company. So, Chargepoint has been in a tough spot now. In the last year, the stock is down 65%. In the last 5 years, it's down 88%. Late 2020, the stock was $46. And if you don't know, this company operates as an EV charging network provider. Okay, so same thing that Tesla's doing. And I mean, there's less demand for this product or this service now than there was a couple years ago when the EV hype was going on. So that's why this company is struggling, and it's tough for them out there. They're right now they're down to a valuation of $485 million. Their revenue is not horrible. It's not like it's totally going away. They did a $500 million last year, and it's not horrible. It's definitely not growing as fast as it was, but it's not, we're still getting a little bit of growth. Let's see, what does analysts have them doing for next year? So we are looking at, yeah, negative 13% growth this year, a decline of 13%, and then next year, an increase of 28%. Okay, so there could be hope for this company. Analysts also have them doing an improvement in EPS, and into even next year, it's still not going to be profitable, but it's improving. Now, if we look at the actual numbers of what this company is doing, it's a little bit of a different story here because let's go over to their net income. Generally, you would hope that with more revenue becomes comes more profitability, right? You would hope, but not in this case. EBITDA, free cash flow, net income, all of it is negative, and net income has been getting worse. Okay. We're looking at 6 years ago, they lost $75 million. Last year, they lost 450 million. Okay, so the numbers are not good here. The balance sheet is not good either. The balance sheet now is, as you can see in previous years, their debt was not that much and they had a lot of cash. 2022, they were looking really strong. Then the debt skyrocketed and now it's almost equal. It's almost both $300 million. So nothing good there. And what comes with a company like this that loses more and more money? An increase in shares outstanding, which means the shareholder gets diluted, and that's definitely not helping out the stock price because this company is having a tough time paying for their expenses and staying in business and definitely raising more money. And as you can see in this article, it says with the current burn rate of cash and the cash on the balance sheet, the company has about a year's worth of cash left, but raising capital will be a challenge with 286 million in debt and a stock price approaching $1. Now they do have, remember, they do have roughly 300 million in let's see, 300 million in assets, or no, they have 300 million in cash. I'm sorry, 300 million in cash. But the problem still is that their equity has just went from 550 million 2 years ago to then 327. Now we're down to 230. In the last 2 years, their equity has got cut in half. And so I don't know. I find it kind of weird that analysts have them doing for the next year or two an improvement in EPS because their net income has been getting worse and worse. Let's go to their EPS here. So yeah, even in these last couple of years, the EPS is still getting worse. It's not as bad as it was, but it's still getting worse, and net income is getting worse. So I'm not sure why they are super bullish on. I also saw another article that was talking about since Trump got elected, how this is going to affect this company because they're saying it's not only going to, which you can kind of argue. I mean, you can argue the Democrats are going to push the green energy agenda more, but I don't think it's entirely true. It's not, I don't think Republicans are, it's not like Republicans are going to ban it or something, or Trump's going to ban it. I mean, Trump is great friends with Elon Musk now. And so if anything, he's not going to ban EVs or anything like that. But you also could look at that like Tesla's charging network is the biggest. And so I'm sure Trump is going to help out Tesla's charging stations and Tesla's business before he helps out a company like ChargePoint. So there is that to take into consideration. And that got me thinking, well, what if Tesla just bought this company? That's a possibility too, because otherwise, who else is going to want to be interested in this? I don't know why you'd want to be interested in this. I don't see anything attractive about the stock. The equity is going down. There's no great demand for charging stations in the next couple of years. Possibly if things come back and we get another hype for electric vehicles. But I don't think the whole U.S. population is ready to have an EV. I think you'd be lucky to see half of them have an EV in the next couple of years. So that's the difficulty, the difficult thing here. They do have them growing revenue and they do have EPS getting better. So maybe something happens. Okay, maybe things are a little bit better, but still, we need a profitable company. I just don't see any reason why you'd want to invest in this. I see way more bad things going for them than I do good things. And I don't know. That's my analysis for this one. I don't see anything interesting about the stock. I think it's in a really bad place right now. I think maybe Tesla buys them out. Maybe they don't. Maybe Tesla takes most of their business, like what's going on right now. And that's it. I don't know. I'm not very bullish on this one. But thank you for watching, and I will see you in the next video.